Can artificial intelligence beat the greatest investor of all time? This simple question sits at the heart of a fascinating modern challenge. On one side, we have Warren Buffett, the Oracle of Omaha. Name synonymous with patient, long-term, value-driven investing. His track record, built over many decades, is a testament to the power of human judgment, discipline, and a deep understanding of business fundamentals. On the other side stands artificial intelligence, a powerful force of computational logic and data processing. An AI does not have intuition or gut feelings. The core of our experiment was to pit these two worlds against each other in a structured, fair test. To make the test fair and clear, we first translated Buffett's philosophy into strict, machine-readable rules. We settled on 5 core commandments. Rule 1. Buy only businesses with a durable competitive advantage. A moat. Describe that moat in a single, simple sentence. A moat is a structural feature that protects a business from competitors, like a real moat around a castle. Examples. Powerful brand network effect, high switching costs, low-cost production advantage. The one-sentence rule forces clarity and simplicity. Rule 2. Demand consistently high returns on invested capital. High returns on assets mean a company is efficient and profitable. Our proxy, return on equity of at least 15%. That 15% cutoff immediately filters out weak profit businesses. Rule 3. Leadership must use money sensibly. Poor capital allocation can ruin even great businesses. Sensible use of money. Reinvest earnings at high returns or return excess cash via dividends and share buybacks. The AI reviewed capital allocation history and management commentary. It flagged companies with owner-friendly, smart decisions. Rule 4. Buy with a margin of safety. Only when price is well below intrinsic value. Intrinsic value is the business's estimated true worth. Rule 5. Predictable cash-generating businesses. With the 5 commandments clearly defined, the next step was to execute the method. We did not simply ask the AI for its opinion on good stocks. That would be a subjective and unhelpful exercise. Instead, we fed the precise 5-point rule set directly into the AI's programming. The instruction was explicit. Scan every single company within the S&P 500 index. The S&P 500 represents a broad, diverse collection of the largest publicly traded U.S. companies, a robust, challenging data set. The AI was not to look outside this universe. The test stayed contained and focused. The entire process, from ingesting the rules to producing the final list, was timed. It took just under 7 minutes. The AI's analytical process was methodical and relentless. For each of the 500 companies, it began ingesting and parsing massive volumes of public data. 10K and 10Q reports, quarterly earnings, transcripts, investor presentations, financial news summaries. To check for a durable moat, it scanned for keywords and concepts related to competitive advantage, network effects, brand loyalty, switching costs, scale advantages. It then synthesized that info into the required one-sentence description, testing its natural language skills. This initial filter removed businesses without a clear defensible position. To verify Rule 2, the AI extracted historical return on equity data, calculating multi-year averages for consistency. Any company under the 15% threshold over time was disqualified. For Rule 3, it analyzed cash flow statements to track free cash flow deployment. Dividend growth share repurchases. It cross-referenced those actions with CEO commentary from earnings calls. After its 7-minute scan of the S&P 500, the AI produced its final, ranked list of 10 companies. The portfolio it generated was not an eclectic mix of obscure value plays. Instead, it was a collection of well-known, high-quality businesses. The final 10-stock portfolio in order of the AI's ranking was Visa, Microsoft, MasterCard, Adobe, S&P Global, Moody's Corporation, Costco Wholesale, Johnson & Johnson, Taiwan Semiconductor, NVIDIA. Each pick came with a brief, plain-language justification tied to the 5 core rules. The AI's number 1 selection, its top-ranked stock from the entire S&P 500, was Visa. To understand the experiment's results, it is worth examining why this particular company stood out so clearly from the rest. The AI's justification was concise and powerful, describing Visa as a global toll bridge for digital payments. This simple analogy perfectly captures the essence of Visa's business model and its incredibly wide economic moat. Visa does not lend money, so it does not take on credit risk like a traditional bank. Instead, it operates the vast, secure network that allows money to move. Consumers, merchants, financial institutions. For facilitating these transactions, it collects a small fee. This business model is exceptionally attractive for several reasons that align perfectly with our 5 rules. First, it is an asset-light model. Visa does not need to build expensive factories or manage sprawling physical inventories. Its primary assets are technology, brand, network. This allows it to generate enormous profits with very little incremental capital investment, leading directly to consistently high returns on tangible capital, satisfying our second rule. So, what is the final verdict on this experiment? The AI successfully produced a sensible, high-quality list of companies. The portfolio is populated with businesses that possess clear competitive advantages, strong financial metrics, a history of shareholder-friendly management. The top pick, Visa, is a textbook example of a durable, wonderfully profitable business that Warren Buffett himself has owned in the past through Berkshire Hathaway's holdings. In this sense, the AI demonstrated an impressive ability to apply a set of human-defined rules to a large dataset and filter for specific characteristics of quality. It acted as an incredibly fast and efficient analyst. However, it is crucial to state that this is not proof that an AI can beat Warren Buffett in the real world of investing. The experiment was conducted with significant limitations. First and foremost, an AI can only operate on publicly available historical data. It has no ability to predict sudden, unprecedented events like a global pandemic, a major war, the passage of transformative new legislation that could fundamentally alter a company's prospects. This is not financial advice, just an experiment to help you think better. JPG fades in with calm music tailing off.